Most investors think that getting a DSCR loan is super simple. You just show your rental income and boom, you're approved. But that's where they're wrong. Because lenders don't just look at what you're making, they look at what the market says that you should be making. And that's just one of the 5 mistakes that could cost you your loan, your deal, or thousands in extra fees. In this episode, we're going to break down the biggest DSCR loan mistakes investors make and how to avoid them. All right, I'm Peter, and with me is Jason, the co-host of the Clear Close podcast. What's up, Jason? Good morning. All right, let's get into it. You ready to talk about some DSCR loans? Mm-hmm. Yes, and I know you have worked on many DSCR loans as well as other different types of non-QM. Again, we had a video that we made about DSCR and non-QM. We can refer back to that video over here. But we wanted to have a more deep dive into this topic and give you guys our take on the 5 biggest mistakes that borrowers make when they go through with their DSCR loan, and it could cost them tons of money, or it could just derail the project in general.
It's not going to be the same as if it was a government loan, like a Fannie Mae or like a Fannie, Freddie, or a Ginnie Mae loan, where those have very strict or specific ways of calculating that income to qualify you. So with DSCR loans, these are individual private investors that created this guideline to help you qualify using debt service coverage ratio. It's been around for a while, and it's been becoming more popular these days, and a lot more people are trying to buy into it. And again, there's a lot of mistakes and misconceptions, and one of the biggest ones tends to be with the income calculation, because every lender has different guidelines. So guidelines change, investors change depending on market climate, and the loan officer you may be working with doesn't have enough experience, so they don't know where to even take your loan.
Right. Banks, when they give a mortgage loan out, they're always considering ability to repay. So for DSCR loans, it's not so much the ability to repay through an income from your job. It's more of a ability to repay from the income stream that you're making through whoever you're renting it out to, whether it's a long-term rental or a short-term rental. So a lot of investors actually miscalculate their eligibility with DSCR loans because they calculate how much rental income this particular property can make, but that's not exactly how lenders do the math.
So we always, as a lender, look at the most conservative. So if you've had the property and you're looking to refinance it, and your actual rents are $2,000, that could be what you're basing your qualification on. And sometimes you may have a unique situation where your property is getting $2,000 a month and have been for years, but it may come back lower because overall in your market, it may be at $1,800, and it catches a lot of people off guard, and it catches a lot of new loan officers off guard because I work very closely with a couple of my favorite wholesale investors, and they understand like the intricacies. So like some lenders will still use AirDNA, some will say we'll use X, Y, and Z to give us the short-term rental data, and we'll underwrite against that. Or I've asked a couple of them to even just simplify it further. Take your short-term rental pricing, that models that you have, and let's just do it at a lower DSCR ratio. And I got
just like discount it a little bit.
Excuse me?
Just like discount it a little bit, right?
No, not discount it. They add a premium to it because short-term rentals are riskier. They're more unpredictable. There's a lot of occupancy.
Oh, I see.
Lack of occupancy, right? So we have lenders that have opened up their guidelines to 0.75 to 0.99 ratio, and I've even gotten some down to almost a no ratio. So we have flexibility, and its main purpose was to give access to businesses to continue to business owners or real estate investors to continue to find deals and build that portfolio.
Mistake number two, which was inconsistent lender guidelines. There's over 200 lenders who do non-QM, specifically DSCR, and they all have different requirements and different regulations that they have to follow internally, right?
There's so many different levers that you can push and pull. And when it comes to non-QM mortgages, it's kind of like the Wild West because you can't take one lender's guideline or one person's experience through it and compare it with another and say, oh, this company did 15% down on a DSCR for short-term rental, and then this one only required 3 months of reserves, while that one required 12. So it's like people start hearing little bits here and there, and then they assume everybody has the same base guideline. But DSCR non-QM, it's different because there's 200 plus different lenders out there, and every one of them have their different overlays or how they approach or review things, different types of eligibility through like location of property, and it's
Yeah.
basically up to their end investor that's buying the loan because like
Right.
they have a loose understanding of it, and sometimes it's like maybe that bank or broker or wholesale lender you're working with doesn't even just sell it to one person. They sell it to multiple different entities. So when they underwrite your file, they may be over underwriting it because they're trying to make sure that they cover all, like they have all their ducks in a row. Because if investor A, B, C, or D don't take it, they still need to sell it off to investor E.
Yeah, and um, that's a really unknown fact about our industry is that these lenders and wholesale lenders, like you said, when they lend out money for mortgages and they take on that note, they don't just hold on to that note. They sell that note in MBSs, mortgage-backed securities. We don't want to get into the weeds too much on that specific topic because it doesn't really affect the average investor. But um, when I was, working in the corporate world, I worked on corporate loans, and the way it was structured was very, not very business friendly for the business. The lender could cut the line of credit if they didn't see performance on our books. There was a lot of things that the bank can do. But DSCR loans, they're not really like that in terms of the lender can come in and recall the loan if they see too much risk, right? It's not the same.
Yeah, as far as invest with DSCR loans, the bank won't come after you or can't come after you because you've already been final approved, right? But during the underwriting process, they can say X, Y, and Z is needed to make up for these compensating factors or meet these underwriting requirements.
I wanted to make clear for our listeners, DSCR loans have a personal guarantee attached to them, right? And that's another mistake that people don't really realize until they get too
Mhm.
deep into it. A personal guarantee is a very powerful guarantee, and in my experience, they're written in a way where it's very difficult to get out of. And my understanding of DSCR loans is you cannot put an LLC or another corporation entity as the guarantor. It has to be a person.
Correct. So this is where, with a DSCR loan, because you can close in a business entity, people mistake it as there's that you're not personal guaranteeing the loan. So this is going to be a full recourse loan where you may be able to close it in the business name, but
Hmm.
you're the personal guarantor. So if anything happens to that property and you're not making the mortgage payments or something just negative happens like that you can't control in your life, right? And that home forecloses. Since you're the personal guarantor, the bank could come after your personal assets to make up the difference of any losses that they incur from selling it or going through foreclosure. So luckily, the last couple of years, we've been really lucky with consistent home appreciation and very strong rent growth in both long and short term rentals. But if you are looking to actively invest now, I would definitely do a deep dive into the market that you're going into to just
Hmm.
make sure that number one is going to cash flow. It just hits your underwriting guidelines because you're underwriting the deal for your portfolio before we even as a lender underwrite it to qualify you for the loan. So again, when it comes to business, since this is a business for the end user of a DSCR loan, does it make sense or are you accounting for the appropriate risk? Because if it were me as a lender, I'm on the hook too if you don't perform. right? So if my client is looking to buy a short-term rental in a very depressed market with numbers that I don't think are going to work, I'm going to have that conversation with you because again, if you foreclose on it, the bank can come after me too. So it goes both ways.
Hmm. Yeah, the investor group can come after the lender.
Correct.
DSCR loans require the borrower to have a certain amount of down payment and a certain cash reserve that they show during the application process.
Yes, so there's going to be different types of reserve requirements. Again, since there's 200 plus different lenders out there offering these programs, um, generally speaking, they're going to want to see at least 6 months of reserves. And a lot of it will change due to the actual guarantor's credit scores. So if you're well qualified or you have several properties, the amount of reserves required can change. Generally speaking, though, they only look at requiring reserves for the subject property, not your whole
Hmm.
portfolio. So if that new house you're acquiring required 6 months of reserves, you'd be looking at what would that payment be for the principal, interest, taxes, and insurance, multiply that by six. That'll get you there. So, if, say for example, your taxing that full payment is $4,000 a month, you're going to need to show 24,000 in reserves after closing and down payment.
A lot of different parties involved in just a simple transaction. So it does get a little bit tricky. Um, so let's move on to the next mistake that a lot of DSCR borrowers make, which is not anticipating the fees that are associated with these loans. So they go through the application and the originator says, okay, here are the closing costs and fees, and boom, sticker shock. How can people prepare for that?
Most of the people that have sticker shock is because they never actually really thought about it, or they tend to be first time investors, in my opinion, because the real active investors that I know, it's more about relationships and making sure that they can continue to grow their business over time with the trusted partner, right? So it comes at a cost when you have a very experienced broker that knows how and where to take your deal and make sure you close on time and not risk losing your earnest money deposit. Because
Hmm.
the worst experience for anyone to go through is to put a $50,000 earnest money deposit on $1 million home and not close on it. For me, it's like I take that very personal. Like I hate seeing or hearing stories where people come to me days before closing because the other lender couldn't do their job, right? So it costs money to run great businesses, and it's also part of just expense of acquiring a home. So to nitpick over 1 or 2% in cost doesn't make sense when you're looking at a bigger picture. Be smart about it. You know, if it comes back to the saying, even like with just regular financing or regular business, if it sounds too good to be true, it probably is.
Another saying to keep in mind is you get what you pay for, right?
Exactly.
Yeah, especially in terms of service and experience. People who charge more are charging because of that experience and because of the capability, and they know that they're worth that money.
Correct. So it's like you build relationships over time. You can always be the rate shopper, but it's like I've had a guy tell me like my interest rate was too high and my cost was too high, only to come back like weeks later and tell me that I was the best one because when they started the process, they started at 7 or 6%, and then by the time they were getting ready to close, it ended up being like 8%.
And I think it speaks to like the mindset of people coming into a DSCR loan. If you're coming to the mindset of I need a penny pinch and save a few $1,000s, even like let's say you have $5,000 to $7,000 more expenses than what you calculated on your napkin math. And if that's gonna break the deal for you, then you shouldn't do these type of loans because you're basically getting into a property without a lot of money, right? It's a DSCR loan is you're showing the bank that you can make money off of this property, so they'll loan you that money. You put some money down, of course, but over time, if you stick with it, you're not paying the mortgage. Someone else is paying the mortgage for you, and you're profiting off of it a little bit. And then at the end of the day, you're going to own that house. So your asset inflates like crazy. And if you don't have a long-term view or a long-term investment horizon on real estate, that's something that you really need to consider before jumping into real estate investment in general.
Yeah, no, it's pretty interesting because California is not a long-term rental market anymore unless you've owned that property now for like 20 plus years and your cost basis was very low on it and you don't really have a whole lot of debt on it. You'll make everything through appreciation, right? But what I'm seeing more of in California too now is midterm rentals and the possibility of generating some significant cash flow through that method. And I'm seeing that approach too in certain other strong former short-term rental markets where short-term rentals are always changing too, because every region is a little different and you just don't know what the landscape is going to look like in the long term. But it's something you have to prepare for because as an investor or business person, you're underwriting your own deals for your business. Remember that. If this is a real estate business you're planning on growing, does it make sense for your strategy? Have you thought about that? And when we get introduced together to figure out if that's a good deal for you, I like to have that open discussion because that's the most fun part about being a mortgage broker. And then I can share and we can throw ideas back and forth and see if that deal that you're trying to add to your portfolio makes sense.
Yeah, with all the uncertainty around not just the stock market, but with the real estate market and, the Trump tariffs are live now. It's just a very uncertain time. I feel like we're going to need to cover this topic a little bit more because people are looking to grow their wealth. And if there's ways for us to help them to achieve their dreams of financial freedom, of, supplementing their income and having generational wealth, I think that's something that resonates with every American and every person out there. And so I feel like we should definitely cover this topic more, Jason, not just DSCR, but other non-QM and investment type of loans. So yeah, for everyone out there listening, thanks for tuning in. Getting a DSCR loan doesn't have to be complicated if you know what you're doing and if you have good partners like Jason, and me, and Nikki, who have done hundreds of DSCR loans and non-QM loans, mostly Jason and Nikki. Now that you know the 5 biggest mistakes that investors are making, you can avoid them and make good decisions for yourself. Please do your own diligence and research, and we're always here to help you and give you second opinions and be a sounding board. Make sure you click the link in the description below. That way you can get a one-on-one free consultation, and we'll see you guys in the next one.
The most investors think getting a DSCR loan is simple, but it's not. Oh, great, and it died. All right, I guess they doesn't want me to do this today for you.
I'll do it. Your light just died. Good thing we recorded everything beforehand.